Imagine trading without a single indicator, no RSI, no MACD, no moving averages, yet reading the market with more precision than 99% of traders. That's exactly what Richard Wyckoff mastered. He didn't chase colored lines, he followed the silent footprints of smart money. Picture this. A stock collapses on heavy volume, panic everywhere, but suddenly the sell-off slows, volume dries up, and price forms a quiet test. Most traders wait for their indicators to turn green. But Wyckoff traders recognize the real signal, the composite operator absorbing supply. They enter early, while everyone else waits for confirmation that will arrive too late. This strategy doesn't predict the market, it reads it. And once you learn it, you'll never rely on lagging indicators again. Ladies and gentlemen, today I want to show you a truth that most traders never discover. You don't need indicators to trade successfully. In fact, the very tools you rely on may be the reason you're always one step behind the market. Richard Wyckoff proved over a century ago that the market speaks a clear language through price and volume. Long before indicators even existed, when you learn to read that language, you stop guessing, stop chasing, and start understanding exactly what smart money is doing. Today, I'm going to show you a simple, powerful strategy that strips away all the noise and reveals the real story behind every chart. By the end of this session, you'll understand why using indicators is optional, but reading the market the Wyckoff way is essential. Let's begin. Price-volume harmony is the foundation of Wyckoff's entire trading philosophy, and it remains the purest way to read the market without relying on indicators. At its core, price-volume harmony means understanding how price movements and trading volume work together to reveal the intentions of smart money, those institutions capable of quietly accumulating or distributing positions long before retail traders notice. When you study this harmony, you begin to see what Wyckoff called the story behind the chart, a story that indicators can never truly capture because they are always lagging behind the actual forces that drive the market. To grasp price-volume harmony, you must imagine the market as a conversation. Price is what the market says, volume is how loudly it says it. When the two align, they reveal truth. When they conflict, they reveal manipulation, traps, and hidden activity. For example, if price rises on strong volume, it often signals genuine demand, smart money stepping in with conviction. But if price rises on weak volume, it's usually a fake move, a low-effort push designed to lure emotional traders into poor decisions. Wyckoff traders read these signals effortlessly because they prioritize understanding cause and effect rather than chasing indicator-based confirmations. Let's take a practical scenario. Imagine a market breaking above a resistance level. Most traders relying on indicators will see this as a breakout and rush in. But a Wyckoff trader studies the price-volume harmony. Is the breakout supported by expanding volume? If the answer is no, then the breakout is likely a trap. Smart money, allowing price to rise just high enough to attract breakout traders, only to dump their positions into that fresh liquidity. Soon after, price collapses, leaving indicator-based traders confused and frustrated. But the Wyckoff trader saw the imbalance long before the indicator signaled buy. Another example is found in downtrends. When price makes a new low but volume dries up significantly, this is not just quiet selling. It's a sign that supply is being exhausted. Smart money is no longer selling aggressively. Instead, they're waiting, watching, and preparing for accumulation. A bounce becomes more likely not because an indicator crosses, but because the relationship between price and volume reveals a shift in control. This is price-volume harmony in action, reading the subtle tension between buyers and sellers to anticipate future moves before they become obvious. Price-volume harmony also plays a crucial role during accumulation and distribution phases. During accumulation, price may appear to move sideways, but volume tells the real story. On down moves, volume diminishes, showing that supply is fading. On up moves, volume expands, showing subtle demand. These small clues reveal that smart money is slowly, quietly building positions under the radar. Conversely, during distribution, strong up moves may be sold into, showing heavy supply entering even as price rises. This is why Wyckoff emphasized studying volume at every swing. It exposes the invisible hands shaping the market. Ultimately, price-volume harmony teaches you to trade with clarity, confidence, and precision. Instead of waiting for lagging indicators to tell you what happened, you learn to see what is happening right now. You interpret the footprints of smart money, anticipate shifts in market structure, and position yourself ahead of the crowd. When you master this harmony, you gain the ultimate trading advantage, the ability to navigate the market with the same tools used by the professionals who actually move it. Smart money footprints are the unmistakable traces left behind by large institutional players. Banks, hedge funds, market makers, and professional operators whose actions shape the direction of every market. Richard Wyckoff dedicated his entire methodology to uncovering these hidden footprints because he understood one critical truth. The market does not move randomly, it moves when smart money decides to move it. And because these institutions trade in massive volumes, they cannot hide their activity completely. Their intentions appear subtly through price and volume, and once you learn to read these footprints, you gain the ability to follow the true drivers of the market instead of reacting blindly like retail traders. Every major move, every rally, every crash, every breakout, every reversal begins with the quiet preparation of smart money. Before a big markups uptrend, they accumulate positions at low prices. Before a markdown as downtrend, they distribute positions at high prices. And the process is always the same: accumulate silently, move the market sharply, then exit strategically. The average trader only sees the result of the move. The Wyckoff trader sees the preparation long before the explosion happens. This early detection is possible because smart money always leaves behind distinct footprints that reveal their true intentions. One of the clearest smart money footprints appears during accumulation. While the crowd sees a sideways, boring range, smart money is buying heavily on down swings. But they do it quietly. They don't want to push price higher before they're done building their position. So you see wide down bars with high volume indicating supply being absorbed, followed by shallow up bars with lower volume. This imbalance shows who is in control. Most indicator-based traders ignore this phase because their tools give no clean signal. But Wyckoff traders understand that where smart money buys, the next big trend is born. Another powerful footprint is the spring, the classic Wyckoff shakeout. Smart money deliberately pushes price below a support level to trigger stop losses, induce panic selling, and create a pocket of cheap liquidity for themselves. The footprint appears as a sudden sharp drop on increased volume, immediately followed by a rapid recovery. Retail traders see volatility and exit in fear. Wyckoff traders see accumulation and enter with confidence. This footprint can only be detected through understanding of price-volume behavior, not through indicators that react too slowly to recognize manipulation. Smart money footprints are equally clear during distribution. As price moves higher, volume spikes appear on up bars. At first glance, this may look like strong demand, but a Wyckoff-trained trader examines the context. If price rises but closes weak, or if each rally shortens in duration while volume expands, it means smart money is unloading their large positions into retail enthusiasm. This footprint is the prelude to a major decline. Indicators will show overbought. After the fact, Wyckoff traders see the distribution happening in real time. Even during trends, smart money footprints are visible. In strong uptrends, pullbacks occur on low volume, showing no meaningful selling pressure. In weak rallies, upswings happen on low volume, showing demand is fading. These footprints help you predict trend continuation or reversal with remarkable accuracy. Ultimately, understanding smart money footprints gives you a quiet but powerful edge. Instead of guessing where the market might go, you learn to see where the real money is flowing. You stop reacting emotionally and start trading strategically. When you can identify these footprints consistently, you stop trading against the market and start trading with the operators who control it. This is where true trading mastery begins. Supply and demand imbalance is the invisible engine that drives every market movement, from the smallest intraday fluctuation to the largest multi-year trend. Richard Wyckoff built his entire market methodology on this concept because he understood a timeless truth: price does not move because of news indicators or predictions. It moves because supply and demand become unbalanced. When demand exceeds supply, price must rise. When supply exceeds demand, price must fall. And when the two are in equilibrium, price drifts sideways. But beneath these simple principles lies a powerful framework for reading the market with clarity and precision, without a single indicator. To fully understand supply and demand imbalance, imagine the market as an auction. Buyers and sellers are constantly negotiating, adjusting their bids and offers. When more aggressive buyers step in, they consume available supply, forcing price upward. When sellers overwhelm buyers, price is pushed downward. But these imbalances do not occur randomly. They often stem from smart money preparing for large moves. This is where Wyckoff's brilliance comes in. He taught traders to study the subtle shifts in price and volume that reveal early signs of imbalance before the crowd notices. Consider a simple example. A market in a downtrend approaches a previous support level. Retail traders expect a bounce because the level worked before. But Wyckoff traders look deeper. They observe whether selling pressure is increasing or decreasing. If price hits support on heavy volume and closes weak, supply is still dominant, meaning any bounce will likely fail. But if price reaches support on diminishing volume and begins to hold its level, that signals supply exhaustion. Here, demand begins to quietly emerge, creating the early stages of an imbalance that may lead to a reversal. Indicators won't show this shift until much later, but the price-volume relationship makes it clear in real time. Supply and demand imbalance becomes even more powerful during trading ranges, the birthplaces of major trends. In an accumulation range, down moves begin to lose strength as selling volume dries up. Demand shows itself in the form of stronger up bars, quicker rallies, and tests that reveal a lack of supply. This imbalance builds slowly, and once the majority of supply is absorbed, price breaks out with force. Retail traders see a breakout. Wyckoff traders saw the imbalance forming days or weeks earlier. On the other side, distribution ranges show the opposite pattern. Up moves begin to weaken, rallies shorten, and bearish bars appear with heavier volume. These clues tell the trained eye that supply is quietly overwhelming demand. Even though price may still rise in the short term, the growing imbalance foreshadows a significant decline. Most traders mistake this for bullish momentum. Wyckoff traders recognize a shift in control. One of the most dramatic examples of supply and demand imbalance is the spring or shakeout. Smart money intentionally drives price below support to trigger panic selling. This sudden surge in supply allows them to buy huge positions at discounted prices. But here's the key. The immediate recovery and strong close reveal that supply has been absorbed and demand is reclaiming control. This imbalance creates powerful upside momentum long before indicators recognize the trend change. Ultimately, mastering supply and demand imbalance gives you the ability to see the market as it truly is, not as a collection of signals, lines, or patterns, but as a dynamic auction driven by shifts in effort and pressure. When you learn to recognize these imbalances early, you stop chasing moves and start anticipating them. You trade with confidence, precision, and the same understanding that guided Wyckoff and the smart money operators who continue to shape the market today. The Wyckoff Confirmation Signal is one of the most powerful concepts in the Wyckoff method because it teaches traders to recognize genuine market strength or weakness without relying on lagging indicators. Unlike traditional indicator-based confirmation, which often arrives late after the move has already happened, the Wyckoff Confirmation Signal is rooted directly in the behavior of price and volume. It provides real-time clarity on whether smart money is preparing to move the market, absorbing supply, testing demand, or orchestrating a reversal. For traders who want to eliminate the noise of indicators, this confirmation method becomes the backbone of precise, confident trading. At its core, the Wyckoff Confirmation Signal is about validating the market's intentions by analyzing how price behaves at key moments after a breakout, after a spring during a test, or during the formation of a trend. Wyckoff taught that the first move is never enough. What truly matters is the response, the character of the follow-through. Smart money leaves clues in these responses, and they serve as confirmation that a bigger move is underway. Take the classic Wyckoff spring as an example. A spring occurs when price dips below a support level to trigger stop losses and create liquidity. Many traders mistakenly enter as soon as the spring appears. But the Wyckoff Confirmation Signal requires a controlled, low-volume retest of the spring level. If the retest happens with significantly lower volume and price refuses to break lower, this confirms that supply has dried up. This signal, created by the behavior of the market itself, carries far more credibility than any indicator cross because it reflects actual absorption of selling pressure. Once confirmed, the probability of a markup increases dramatically. Another powerful form of Wyckoff confirmation occurs during breakouts. Most traders rush into a breakout candle simply because price moves above resistance. But Wyckoff traders wait for confirmation of successful backup, Buoy high or LPS, a pullback that tests the breakout level on reduced supply. If volume remains low and price holds above resistance, the breakout is legitimate. If volume spikes and price struggles, the breakout is likely a trap. This method prevents traders from falling for false moves engineered by smart money to harvest liquidity. Wyckoff confirmation turns breakouts from risky gambles into high-probability entries. The confirmation signal also shines in trend continuation. During an uptrend, Wyckoff traders monitor each pullback. If a pullback shows decreasing spread, narrower candles, and declining volume, it confirms that supply is weak. This means the trend is likely to continue. Conversely, if a pullback shows increasing volume and wide spreads, it signals growing supply, indicating that smart money may be preparing a reversal. Indicators can't distinguish these nuances, they simply follow price after the fact. Wyckoff confirmation allows traders to stay aligned with institutional behavior in real time. In distribution, confirmation shows itself through upthrusts and UTDs. Price pushes above resistance to lure buyers in, then collapses with high volume. The confirmation comes when price retests the breakout level and fails again on weak upward movement. This confirms that smart money used the upthrust to distribute positions and a markdown is imminent. Ultimately, the Wyckoff confirmation signal empowers traders to operate with precision. It filters out noise, prevents premature entries, and validates true institutional intent. By watching how price reacts after key events and using volume as the lie detector, you gain confirmation rooted in market behavior, not in delayed mathematical calculations. This is confirmation the Wyckoff way: objective, powerful, and aligned with the forces that actually move the market. Indicator-free trading mastery is the highest level of skill a trader can achieve, because it means you've moved beyond relying on external tools and have learned to read the market directly. Through pure price action, volume behavior, and the underlying logic of supply and demand. This is exactly how Richard Wyckoff traded. He didn't need oscillators, moving averages, or trend-following algorithms. Instead, he developed a deep understanding of how smart money moves the market, and he used that understanding to anticipate major shifts long before typical traders caught on. When you master indicator-free trading, you free yourself from dependency on lagging signals and start trading with the clarity and precision of a true market operator. Many traders rely on indicators because they want simplicity. A line crossing another line feels like a clear decision point. A color change feels like a green light. But what most traders don't realize is that every indicator is derived from price and volume, meaning it is always late. By the time an indicator shows a crossover, the real move has already begun. The professionals who move the market have already entered, and retail traders end up reacting instead of anticipating. Indicator-free trading mastery flips this dynamic entirely. Instead of being the last person into a move, you become one of the first. The essence of this mastery begins with understanding market structure, the natural rhythm of accumulation, markup, distribution, and markdown. These phases repeat in every market and every time frame. When you learn to identify where the market is in this cycle, you no longer need an indicator to tell you whether it's time to buy or sell. The structure itself tells you. Accumulation shows itself through absorption, weakening supply and springs. Markup shows itself through higher highs, strong demand, and low volume pullbacks. Distribution appears through upthrusts, weakening rallies, and heavy supply entering the market. Markdown displays itself through breakdowns, failed tests, and trend acceleration. These are the language of the market, real, raw, unfiltered. Another core pillar of indicator-free trading mastery is reading volume correctly. Volume is the lie detector of price. It reveals effort, participation, conviction, and absorption. When price rises on low volume, something is off. When price falls on high volume but closes strong, supply is being absorbed. When a breakout happens with increasing volume and strong closes, demand is genuine. When a breakdown occurs with low volume, you know supply is not strong and the move may be fake. All of these insights are available instantly without waiting for an indicator's interpretation. Next comes effort vs result analysis, one of Wyckoff's most powerful tools. This principle teaches you to compare how much volume effort enters the market versus how much price actually moves as a result. If effort increases but result weakens, smart money is opposing the move. If effort decreases but result strengthens, smart money is supporting the move. Indicators cannot capture these nuances, but your eyes and trained mind can. This gives you a level of insight that no RSI, MACD, or moving average can replicate. Finally, indicator-free trading mastery gives you something that indicators never can: full confidence in your decisions. You're no longer guessing based on mathematical formulas. You're reading the actual behavior of the market. You understand what smart money is doing, and you position yourself accordingly. You enter before the crowd, manage trades logically, and exit with precision. This mastery isn't about complexity, it's about clarity. Once you learn to trade without indicators, you'll wonder why you ever depended on them in the first place. In the end, trading mastery doesn't come from adding more indicators, more signals, or more complexity. It comes from stripping away the noise and learning to see the market as it truly is, an ongoing battle between supply and demand, shaped by the footprints of smart money and revealed through the harmony of price and volume. Wyckoff didn't need oscillators or moving averages to understand this battle, and neither do you. When you learn to trust the story written in the chart itself, you stop reacting and start anticipating. You understand where the market is preparing to move, not where it has already been. This simple, powerful approach allows you to trade with clarity, confidence, and precision. Master the principles, not the indicators, and you'll unlock a level of trading skill that is 10x stronger than any tool ever created.